Well, welcome back. We are watching the Federal Reserve today. Markets are anticipating some news later. The Federal Reserve's decision on interest rates, of course, expected no change in rates. But we are expecting news from the conference where the central bank will give us details on the plans to unwind the more than $4.25 trillion balance sheet. Markets, as you see there, are flat. Joining me right now is Jack McIntyre. He is the Brandywine Global Portfolio Manager with $72 billion in assets under management. And Jack, it's good to see you. Thanks so much for joining us. You were just telling us that you have were you short the dollar? You really call this dollar move well.
Yeah, we have. And there's a couple of things driving that. So we had close to a sort of record underweight U.S. dollar exposure. Two things. One is the most important thing is that there's better growth away from the U.S. So capital gravitates towards its highest return. Right now, that's in the emerging markets. Secondarily, though, you've got a president that clearly does not want a strong dollar. He's putting America first. He wants our corporations to be competitive. That means we're going to get a weaker dollar.
Wow, interesting.
Yeah, I mean, I looked this morning at the futures market and actually looked at currencies. I saw that the euro is at 120 now. We're seeing the pound is up 0.5% at 135. Is there going to be any slowage to the dollar getting weaker? I mean, we've seen it come down so precipitously this year. It's really driven the market, especially here, and EM, as you've talked about. So where do we go from here?
Well, so the first thing to be on the lookout for, and you've seen it a little bit at the margins, is that central banks, the ECB, Bank of England to a lesser degree, but they're going to be a little concerned about currency strength in here. It's just going to be rhetoric right now, but I don't think it's enough to derail this negative move in the U.S. dollar. Our view is that this dollar tends to move in cycles, so it should be weak, if we're right, for the next 3 to 5 years.
Oh, we got a 3 to 5 year
Yes, that's our time horizon.
So that's why you're going into EM, because if the dollar goes up, EM gets hurt.
Exactly.
You think we'll hear anything from the Fed today in terms of the winding down of the balance sheet and its impact on equities?
Well, I think so obviously they're not going to move today. I suspect we need to get a start date on when they're going to start to reduce the balance sheet. So I do. One of the things I want to be on the lookout for is, though, in the FOMC text, in the press conference, how do they talk about inflation? Because up until that August CPI number, inflation had actually been coming down, but that the CPI number in August came in a little bit better than expected, higher than expected.
Well, the CPI number in August, a lot of that was the move up in energy prices, right? But broadly speaking, your core inflation is muted to the point that the Federal Reserve's kind of in a bind, if you will.
Yeah, and that to me is part of a broader theme, which is good for risk assets in general. So we do have this broad-based global growth, and it's the first time in roughly about 10 years. But the key is it's not generating inflation. So that means the Fed can go very slow in removing stimulus in here. They don't want to sort of derail it, go too fast, and then take the economy into a recession.
So why would I buy EM? Why would I buy emerging markets in that scenario?
Well, because you look at what's getting discounted in their bonds, the currencies, everything is still undervalued. We view this cycle as sort of being 3 to 5 years as well. They peaked in 2011. Clearly, a lot of money in the short run has come into EM. But, we're not trading oriented. If your time horizon is measured in years, there's still a lot of value there.
Jack, you're painting a pretty rosy scenario, which I happen to agree with, by the way. Right, but I was going to say, but tell me the risks then. What's the biggest macro risk here? Then?
Okay, so there's a couple of things. One is that, and it's going to get a little bit more challenging here because the data is going to be influenced by the hurricanes. And the key is, is it slowdown because of the hurricanes, or is there actually something else slowing the U.S. economy? And then the Fed continues to sort of tighten. Hey, the other thing, though, is with this balance sheet reduction, I'm not sure it's going to be like watching paint dry, and that's what the Fed has told us they expect in here. So if the economy's slowing and they stick to this reducing the balance sheet, then we
haven't done this before.
No, we haven't. And this is a big monetary
Will this be disruptive to the U.S. stock market?
No, because the reason being is that, so the Fed is slowly tightening. Well, what's been stimulative? Well, the dollar weakness has actually been improving financial conditions. We've had a lot of wealth created because of the equity market. And you look at market rates. Interest rates are still low. So to me, that offsets the fact that the Fed is going to be...
Well, and they telegraphed it
There's
very
been a
well.
sell-off in government bond prices, a 6-day slump. That's the longest losing streak since March of this year. So the 10-year yield is still very low, but again, there is some concern about this unwinding.
Yeah, that was one of the top stories this morning in the Journal, right? They're talking about the slump in bond prices, unease as the market gets ready for this unwind of the Fed.